Good to be back with you once again on the India Development Debate right here on ET Now. Time to put the spotlight on growth pangs that are back to haunt the Modi government, weighed down by high fuel prices and weak consumer demand. GDP growth slipped to 7.1% in the second quarter of this financial year, lower than what markets were expecting. Between 7.4 to 7.5% is what the broad expectation was, especially given it's coming on the back of 8.2% in Q1. Gross value-added growth, or GVA, slowed to less than 6% for the first time in 3 quarters. What is worrying is the big contraction in industrial output, while fault lines appeared in the farm sector as well, growing at sub 4%. While lower GDP growth is bad news for industry and the market, the number will also have political ramifications, coming at a time when the government and the main opposition party are locked in a battle over fiscal management of the Indian economy. The centre is not in a position to step up spending considering the weak financials. Just wanted to remind our viewers that the fiscal deficit has already touched nearly 104% of the budgeted target of 3.3%, leaving hardly any elbow room for further manoeuvring. The stress on the macro front and what the Q2 GDP is really telling us is a big topic of discussion and debate right here on the India Development Debate this evening. Joining us on the show, a very special panel, Dr. Naushad Forbes, former President CII, and of course co-chairman Forbes Marshall, Mr. R. Gopalan, former secretary in the Department of Economic Affairs and also India's former finance secretary, V. Anantha Nageshwaran, Dean IFMR Business School, Korea University, and of course Maithili Bhusnurmat, consulting editor, ET Now, and economist. Thank you very much all of you for being with us. And if I may begin with you, Naushad Forbes, India's Q2 GDP has come in at 7.1%, and that's the growth numbers that we are talking about. It's a massive fall from 8.2 that one did see in Q1. You know, the headline is we've still beaten China, which grew at just 6.5% in the same period at the same time. Is that solace, or is 7.1% disappointing?
So I think we should recognize that the fall from 8.2 to 7.1% is largely a result of base effect. Last year in Q1, because of the upcoming GST implementation, we had very low GDP growth. So we saw a recovery from that low GDP growth number of last year in the first quarter of this year. Things are equalizing now. So I wouldn't be so concerned about the 8.2 and 7.1. I would be concerned though about the long run GDP growth of the country. I would be concerned about how we can get our GDP growth up to very close to the double-digit mark, because that's what we need as a country to really include millions of our population in the growth rate. So I think the short-run changes from quarter to quarter, at least for me, are less of a concern. The long-run GDP growth trends are much more important.
No, I agree, and I think it's always the GDP trajectory that should be of more value and of more semblance than just the quarter dip or the quarter blip there. But Anantha Nageshwaran, one of the reasons that is being attributed to this fall in GDP growth, of course it's coming in on a base of 6.3% in the last financial year around the same time, but private consumption has dipped, and obviously that's on account of the liquidity crunch that one saw in the NBFC space and all of that. How much of that is on account of the liquidity crunch in the NBFC space? Because you know, the argument can be looked at from the other side as well. The liquidity crunch actually happened in the last part of September and not so much in all of Q2. What would you then assign or attribute that subdued consumption to?
The liquidity crunch happened all towards the end of the second quarter, therefore that can't be the explanation. But I think in the absence of very special factors, I would go with Mr. Naushad Forbes' explanation that the first quarter was flattered by the base effect. And what you are seeing, if you look at the half-yearly performance, April to September, we are seeing 7.6% for for the first half, April to September, compared to a 6% growth rate last year. So things are probably stabilizing, and I think this is probably a more accurate view than a quarter-to-quarter, non-seasonally adjusted data. I'm trying to interpret that.
Maithili, you know, while consumption has been weak, and you know, I agree that quarter-to-quarter data should not be given so much of importance, should not be scanned through for more answers, but consumption has dipped, and you know, if you actually go with the high frequency data, car sales are down and all of that. I know it's going to have a lag effect, and my next question is going to be on this. But 7.1% is coming in at a time when manufacturing has gone well, construction has gone well, and I'm going to talk about those sectors individually. So I'm not preempting an answer here. But how disappointing then is 7.1 for you? Because unlike what a lot of people will say, liquidity crunch, that liquidity crunch actually happened just in the last part of September. It couldn't have impacted the entire quarter, and we are really reporting numbers of the entire second quarter here.
Well, I'm already disappointed with 7.1. Yes, it is a little below the consensus estimate, or rather the range of the estimates between 7.3 and 7.5. But I would agree with Naushad and Anand that 7.1 is not bad going at all, particularly if you discount for the high, you know, the base effect of the first quarter. But because the first quarter of last year we got GDP growth at only 5.6%. So if you discount for that, then 7.1 is not bad at all. And if you pass the numbers and look at the disaggregated numbers, the sectoral performance is even better, because manufacturing and construction, the two sectors which add to jobs, they have done quite well. Also, the gross fixed capital formation, both in current as well as constant prices, is not only sequentially but also on a year-on-year basis substantially better. So I think overall I would be not at all unhappy with the quarter numbers for the second quarter, and the first half year, as Anand has mentioned, at 7.6 is pretty good going for an economy.
Okay, 7.64 is good going for the economy. Mr. Gopalan, coming to you, how would you expect the third quarter to pan out? Because that is where the liquidity crunch will really be felt, and NBFCs do cater to large parts of consumption. Rajiv Kumar was with us, I think, some days back, and he said he's worried about the third quarter, he's worried about the second half growth numbers, because things will look subdued. The liquidity crunch is going to take a toll on consumption. So how worried are you, and how acute can the impact be? And in some sense, what we are giving up on liquidity, we're making up with oil and all of that. But just first, let's address the elephant in the room. The third quarter, what will it mean given a liquidity constraint that's going to be perhaps playing out there?
Okay, even in the second quarter, some of the consumption numbers were showing a disturbing trend, which is about in vehicles, diesel consumption, passenger vehicle sales, credit, rural agricultural wages, domestic two-wheeler sales, tractor sales. They were all showing really entering into problem areas in the second quarter. Now, with the liquidity crunch coming in, and consumption, private consumption having, it's not increased the way it should have increased, has really, shown from 8.6, it had gone to 7% in the second quarter, private final consumption expenditure. So this has set the tone for this. Now, with the liquidity hitting in the third quarter, with MSMEs and others not able to access enough credit to grow, and with the trend of consumption going down on account of these factors, I am worried about the third quarter and third and fourth quarter. If we take the second quarter number as 7.1, I may look at the overall annual, the FY19 growth rate at about 7.3 to 7.2 to 7.3, and not more than that. But let me tell you, that's a good growth compared to most other countries. It's a good growth. So once again, one needs to look at whether we are living up to our potential, or is it something we can do better, and these are the issues which will take up the time of all the people who are looking into how the economy is going to go forward.
I think all the people who are looking into the economy are embroiled in a big debate on what is the real growth that India is seeing in the past and what will we see in the future. But I think 7.2 or 7.3%, I wonder if that's a real growth potential. So Dr. Forbes, A, that question. And second, of course, you've got your skin in the game on this one. Manufacturing growth at 7.4%, many people will believe is steady. But is it good enough to make big investments start breaking ground?
It's not.
I think we should, when I said that we shouldn't be too concerned about the 7% growth of the second quarter, I said it with respect to the change from the first quarter. So I was talking about the quarter-to-quarter growth performance. But I think we should be disappointed with the growth of the Indian economy in the last 6 years. Whatever the change in GDP basis of calculating figures and so on is, I think we should be disappointed with a growth rate that is 6% or 7%. We need to do a lot better. We need to do 9-10%. That's what China did throughout the 2000s and 1990s. That's what South Korea and Taiwan did throughout the 60s and 70s. That's what Singapore and Hong Kong did throughout the 60s and 70s as well. That's what we need to do too. We need 20 years of 9-10% growth. That's going to take a lot of change in the economy, and it will only happen if manufacturing plays its full part. Manufacturing needs to grow at rates above 15%. The previous government and this government have both had the aspiration of raising the share in manufacturing in GDP from 15% to 25%. It was 15% in 1991. It's 15% in 2017. The share of manufacturing in GDP has not budged one bit, in spite of Make in India, in spite of the initiatives of the previous government and the present government. That's what we need to address if we really wish to see our growth rate reach the kind of potential we require as a country to lift millions of people into the growth process. Yeah, I'll add one last comment, by the way, on investment. We're now in the 7th year of subdued industrial investment. Yeah? Yeah, so the 7th year of subdued industrial investment. The last 2 years of the UPA government and all 4 years of the NDA government have not seen a recovery in industrial investment. The last 2 years of the UPA government saw a fall in industrial investment, and the first 4 years of the NDA government have not seen a recovery in industrial investment. Industrial investment and fixed capital formation by industry continues to be running at a 10-year low. That's not what we need as an economy.
But that's precisely the question. You're actually directing me to my next question, because in some sense that is the elephant in the room, private investment. And you're right, the GFCF at levels at current prices, at levels of sub 30%, at 29.3, 29.2, whatever that number has come, at sub 30% is not commensurate with high growth. It is not going to lead to job creation. It will not make hiring easy. It is not going to make projects take off. Anand, that is the elephant in the room, the gross fixed capital formation. And here you have policymakers rejoice. As a ratio of the GDP, it has gone up by 1.3%, but it doesn't matter because it's just gone up year on year, up by 1.3%. The reality is that private investment in India is still not breaking ground. The big investment is actually the public sector investment that's happening. How do we ensure that virtuous cycle is put into motion?
If you go back and look at how the investment boom between 2003 and 2008 happened, we also had a bad loan crisis since the mid-90s, and corporate sector was deleveraging, and by the time the global economy began an upswing, the Indian corporate sector was in fine fettle. The balance sheets were lean, they could borrow and they could invest, and capital inflows from the developed world also played a very big role. So I think right now we have the global economy isn't doing particularly well, although on paper we had a rebound in 2017 and into the first quarter or second quarter of 2018. But I'm not too sure how much of it was real and how much of it was statistical. And also, if you look at the twin balance sheet issues, including in the power sector and the introduction of GST, etc., I think the investment cycle in India isn't about to fire as it did between 2003 and 2008, and I must say that the Indian economy is far too fragmented to be able to create the kind of capital investment boom that happened in that period, because a lot of factors were aligned favorably between 2003 and 8, and I don't think they are coming back. So I think we need to focus on the fragmentation of India's farming and the factory sector. We have far too many micro and nano enterprises to be able to repeat the kind of boom which was one-off and freakish, in my opinion. So to aspire for a double-digit growth rate is one thing, but to look at the underlying condition that would facilitate it, we are far away from that.
You know, I'm tempted to go to Mr. Gopalan and Maithili, but I will take a quick follow-up question with Dr. Forbes because, you know, Indian industry is the one that has to invest and they're not investing. And Dr. Forbes, I like the fact that you're being candid here to say, you know, private investment is at a 10-year low. Why are you not investing? We seemingly seem to be jumping up positions on the ease of doing business, but you and your peers are not very gung-ho on investing in India right now. Why is it so? It can't be capacity utilization and, you know, over-leveraged balance sheets alone.
So it actually has a lot to do. If you take general industrial projects, I'm not talking about, you know, specific infrastructure sectors like power and so on, but if you take general industrial projects, general industrial investment, which is really what matters for the wider economy and certainly what matters for employment creation, it has indeed been subdued. As I said, it's been subdued for 7 years. What's going to bring about that recovery? The first factor is certainty. I think, you know, whatever your view on demonetization and its merits or demerits, the one thing that demonetization did was it fostered a huge degree of uncertainty in the economy. When you foster uncertainty, you kill investment intentions by industrialists, because you say, let me see what happens and then I'll see. And I think uncertainty is the single factor that ends up damaging industrial investment more than any other factor. If you look at the headlines of the last few months with the whole ILFS issue that's been going along, the tussle and fight between the government and the Reserve Bank, all of this fosters uncertainty. And I think we need a certain environment. So that's where there's some positives. For example, our commitments to fiscal rectitude, our commitments to actually adhering to the fiscal deficit that has been projected by the finance minister, his repeated commitments that we will stick with the commitments he made in the last budget, those are all very welcome. You need much more of that. You know, the first rule of government should be do no harm. The second rule of government should be, okay, once you do no harm, then find ways in which you can start doing some good. But first, do no harm. And I think ensuring stability, ensuring that the fiscal deficit is in control, and then ensuring that industrial investment is welcomed. The last comment that I'd make is I think there's been too much of tarring all of industry with the same brush in terms of somehow saying that all of industry is somehow like ILFS, or it's like Vijay Mallya, or it's like Nirav Modi, or it's like Mehul Choksi, or it's like any one of these characters. And Indian industry is not like them. Indian industry is much different. 99% of industry is just fine. And 99% of Indian industry needs to be respected and expected to do the right thing for the country. And only if we expect industry to do the right thing, we reward it for doing the right thing, and we respect it for doing the right thing, will we see a rekindling of animal spirits, will we see a recovery in investment, and will we see industrialists starting to invest in the country and create the kinds of jobs that we need.
Oh, absolutely, and I'm glad you're being candid. You know, I wished Indian industry was as candid as you. You can't all be painted the bad boys. There are some rotten apples there, but by and large, Indian industry has contributed to nation's growth, has contributed to development, job creation, and all of that. You're absolutely right, and that leap of faith and that confidence building has to happen. But I've got little time left in the show, and Maithili, I'll come to you. There is something that's amiss. There is such acute stress in agriculture. You look at the farmers out on the streets of Delhi and that will give you a sign of the pain that Indian agriculture is going through. But statistically, things are not looking as bad at 3.8%. Is there a disconnect of sorts here?
Well, yes, there certainly seems to be, which is why I think it's very important when you look at GDP data to see that GDP data is not the be-all and end-all of everything. The fact is that the Indian farmer is suffering today precisely because there's agriculture production is done so well. So because the agricultural output almost year after year, food production has increased dramatically and prices have fallen, there is distress in the farm sector. Fortunately, the farm sector is now diversified and you do have a lot of non-food grain output as well. You have horticulture, pisciculture, etc., floriculture, and you have a lot of other activities as well in the rural economy. So this to some extent does cushion the harm, the damage to the farmers, but that is not enough because most of the farmers in India are small farmers, so they are hit by low prices. So government clearly must do something to alleviate the farm distress. So because despite the fact that macroeconomically, if you look at the numbers, agriculture sector has done very well. If you look at the average over the past 8 quarters or 9 quarters, it's over 4% growth, but that's not enough. There is genuine distress. Hopefully the efforts that the government is taking will have some impact, but ultimately I think you do need the kind of reform in agriculture that we saw in industry. Do away with all the controls in the input as well as the output side, but that's going to be a long time to come. So hopefully the government will work at it, and meanwhile it have to do something to alleviate the distress, which is really going to spill over perhaps into the election results also. So the government must be very wary of that.
Right. No, I will take a quick question to Mr. Gopalan. I'm very short on time here, and Mr. Gopalan, if you can answer this question directly. Fiscal deficit at levels of 103.9% so far, and even now the government is very confident that it's going to meet the fiscal deficit. We are given to understand it's going to be the PFC, REC kind of a deal. Will the markets and will stakeholders be forgiving of that kind of meeting of the fiscal deficit, maintaining the fisc at that level? Because the quality of fisc is what should really matter. And an ONGC, HPCL kind of a deal or a PFC, REC kind of a deal is not real divestment, is not real economic management. I'm given to understand that the fiscal deficit could be managed with deals like that. Are you impressed?
Well, I mean, already we have got shortfall in revenue, in GST revenue, close to about 60,000 crores, which I mean flagged last time when we had a discussion. Now, direct taxes is doing well. So, with probably slippage of 0.2 to 0.3, I think they are going to do a lot of things with IGST and cess sharing. There will be one issue there. Subsidies payment will be postponed by a quarter or some such thing. Now, other, I mean, like people like HUDCO, REC and those kind of people will be allowed to go into the government supported bond floating programs. So, a lot of these adjustments will certainly take place, but the quality of adjustments apart from borrowing from small savings for Air India and NHA and those kind of issues directly. Now, this will indicate to the people that the fiscal deficit will be close to about 4%. Now, fortunately, the states are holding, and the state's fiscal deficit is not going to be beyond 2.5 or 2.6 this year. I am happy with that. So, the problem that is going to happen is that markets will not, I mean, will see that, I mean, this is not a very good way of managing a fiscal deficit, but to that extent the markets will be little lukewarm to that particular. If somebody says that we are doing a fiscal deficit, containing a fiscal deficit, the markets will be little lukewarm to that. But once again, it depends on a number of other factors as well. If money is going to flow from any easing or some such thing, which is not going to happen, there are other factors which can come in and save the day as far as the Indian markets are, I mean, concerned. But my personal view is that markets will certainly see through this kind of calculations, and my estimation is the fiscal deficit this year with all these taken into account will be about around 4% for the center.
Okay, fair point. Anand, very quickly, and please keep it very, very brief. I've actually overshot my time. My producer is giving me just an extra lifeline there. But RBI stance, low growth, inflation undershot, what is it going to do? And is there now a given that there will perhaps be a change in stance at least to neutral?
Well, I guess they will probably not cut interest rates in the next meeting. They will probably indicate a readiness to cut in the new year. I don't think we are getting a Christmas gift from RBI.
Okay, that's as short and crisp as Anand Nageshwaran can make it. But thank you very much, all of you, for joining us right here on ET Now. Dr. Naushad Forbes, Anand Nageshwaran, Mr. R. Gopal, and of course, Maithili Busnoor, Mana Consulting Editor. Thank you very much for sparing time and being with us as we discuss and debate the real GDP growth numbers, because these are numbers that impact our lives, our livelihood, job creation, investment, and all of that. We've chosen to keep the politics out of this because as it is, it's playing so much on the numbers, the methodology, and the new series. Thank you very much for being with us.